You just came out with a report about the private credit market and the transactions in 2019. Looking forward to 2020, what are you expecting to see in terms of total volume and the size of scope of it?
Sure. So we're expecting to see more volume. Last year, we saw about a 40% increase in total transaction volume. Deal flow was up about 25% as well. Everything we're hearing from our clients is there's a lot more coming. We actually do a survey of our clients that's going to be coming out in the weeks ahead. We'll have more information on that as well, but we totally expect that there's going to be more flow coming.
So a record year potentially in
absolutely.
issuance. I'm trying to understand, one thing that you pointed out in 2019 was that each transaction was larger in size. And I'm wondering why these deals at this point aren't going to the broadly syndicated loan or high yield bond market.
Sure. So, I mean, that execution is always there. But what private credit offers is certainty of execution, usually club-style execution, so 2 or 3 players for most loans. And also, you don't need the syndication or the flex that's associated with going to the syndicated market.
And what about the actual yield? I mean, are they paying more for, are the companies having to pay investors more for the privilege of, or the lack of privilege of not having the liquidity in the secondary market?
Yeah, I mean, generally it's priced actually pretty equivalent because most of the borrowers have the ability to either go to the syndicated option or to the private credit. In some deals, we do see a slight premium associated with it, but these deals are still priced pretty low. Most of the deals we're seeing are LIBOR 5.5 or less.
Okay, so I understand the proposition from the company standpoint. They don't have to pay up and they don't have to deal with the mess of actually syndicating something. What about on the investor side? Because you basically are giving up any particular premium to go into something that's going to be less liquid, and you're seeing EBITDA add backs, you're seeing leverage ratios rise. What's the advantage on their side?
Sure. So the investors are buy and hold investors, and so they're not looking to trade out. Most of our clients very rarely will actually trade. So they're looking to underwrite a company, to find a solid company. And even though there are expansions in EBITDA add backs and financial covenants, they're getting comfortable with the credit up front. They're doing a lot of due diligence.
At what point, though, do we start to worry, especially about leverage ratios that are creeping up at a time when people say we're late in the credit cycle? I mean, based on time we are, based on any other measure, who knows? How concerning is that?
It's a massive market, and it was a market that the banks were banking for the last 25 years. The banks are largely out of the market now. I think from what we've seen, only about 15% of all these loans are done by banks. So you're talking about 200,000 middle market companies that need capital, thirsty for capital, and they want someone that is willing to give them the loans they need, the leverage they need to grow their business.
How much of the volume that we're seeing in terms of private credit deals are driven by the fact that all of these asset managers just have record stockpiles of cash that have to go to work versus actual demand from companies needing to be financed?
No, I think it's totally on the demand side. They do, look, our clients have a substantial amount of money that they're out investing, but they are prudent and they are taking their time to make sure that they understand the credit. The due diligence process to underwrite these private credit deals is much, much longer than what we would see in the syndicated market. So I do think that there's certainly an overhang of that, but there's also just a tremendous supply that is really untapped.
Just real quick here, do you have a sense of how big this market could get in the next 10 years?
So when I started in this, 20 plus years ago, I mean, we were talking about just a handful of players, 2 BDCs, a couple of insurance companies, and it's now close to $1 trillion. Really, we're not seeing the end in sight. We're seeing larger and larger deals. In the last 6 months alone, we did, what did we do? We did about 25 deals with more than 50 million of EBITDA, with more than $500 million check size.